Hi, I'm Josh Manning, founder and portfolio manager here at Manning Asset Management. Manning Asset Management is a specialist fixed income fund manager that invests in fixed income assets that offer high levels of income yet offer very strong capital preservation characteristics. Manning invests based on where we are in the economic cycle. When I started the firm in 2015, I would commonly hear from investors, where can I find income outside of equities? I want income, but also want very strong capital preservation. And more recently, long duration bond portfolios are really suffering under increased interest rates and decimating returns in that space. But I think there's something even more important happening at the moment. We're in the midst of the most prolific interest rate hiking cycle in modern history. Interest rates globally are increasing due to central banks, and that is reducing the amount of income or cash that both businesses and consumers have to meet their operating or household expenses. Locally here in Australia, almost 1 in 2 mortgage borrowers have a fixed rate loan with many of those expiring in 2023. As these businesses and consumers grapple with this higher cost of funds and lower income to meet expenses, there's never been a more important time for investors seeking income and capital preservation to be both fussy and discerning about how they invest, but more importantly to get the benefits of the higher RBA cash rate, which translates into higher expected returns from fixed income. In 2015 and in April 2016, the fund, we started the Manning Monthly Income Fund. Over those 7 years, we've never had a negative month from credit, and I think that talks to the resilience of the investment strategy. Through that time, we've endured debt ceilings, the rise of zombie companies, the invasion of Ukraine, US-China trade wars, a global pandemic, and of course, Australia's first recession in 27 years. And through all that time, the fund has continued to achieve its RBA cash rate plus 5% objective. The fund has a very strong focus on capital preservation, and we talk a lot about this capital stability element. What that means is that we deliberately target assets and structures which we believe will perform through a variety of macroeconomic conditions, and avoiding areas which we think are susceptible to heightened risk of capital loss in certain scenarios, such as construction finance, which is not in the Manning Monthly Income Fund. It's been consistently rated 5 crowns by Money Management since it was first eligible, and was recently rated highly commended by Evergreen, which is a specialist ratings house and the highest rating possible, and one that they've never awarded to a fixed income manager before. The returns, as you can see over the 7 years, have tracked or not exceeded the RBA cash rate plus 5% objective and delivered over 8.4% net of fees to our investors over the prior 12 months. To put that in context, we've just looked here at the 147 different diversified credit funds here in Australia and seen that and sorted them by the 5-year returns. You can see here that Manning is the top performing fund, and one of the things that we really focus on is this so-called risk score. It has one of the lowest risk scores at 16, which just really shows that it's true to label in that low volatility, capital stability with a very attractive return. So the question then becomes, how do we generate these returns? And it really comes down to 3 things. It comes down to our philosophy, our people, and our process. So in our philosophy, there's 5 points there. It's really the top 2 that are the most important. The first is protecting capital is more important than achieving returns. And what that translates to is when we go out and look for an investment, we're not looking at things where we say, 99 times out of 100, we think we'll get 100% of our money and interest back. That simply isn't sufficient. We want to do a rigorous, deep due diligence to understand that under a variety of different scenarios, that we think we will get that full repayment at maturity. The next is know what you invest in. We believe research is a contact sport. We don't rely on credit ratings or external research. We do that all in-house. And that involves us going out, meeting counterparties, looking at potential investors firsthand, and developing our own proprietary understanding of both the risks and the mitigants, and making an assessment around whether they're adequate. And we think that's a real edge compared to peers. The third is diversification is critical. We have 10,000 assets in the portfolio today, and what that means is if we have an asset was one particular asset in the portfolio, it's really unnoticeable from our investors' perspective. We prioritise asset allocation, which means being in the right parts of the market at the right time. And lastly, we believe ESG considerations do impact returns and therefore are important. Next, we have our people. Manning has the most seasoned and experienced team of credit professionals in the Australian market, which make up its investment committee. Collectively, we have over 100 years of deep, relevant and diverse experience. The investment committee is made up of myself as the portfolio manager, who previously worked at Jana Investment Advisors and Macquarie Bank. Secondly, the investment committee chair is Andrew Chick, who has a very prestigious career as previously the ex-CEO of Royal Bank of Scotland in Australia and New Zealand. The team is also complemented by Adrian Bentley, who is the Chief Investment Officer and has nearly 40 years of experience in this sector, previously working at Bankers Trust and Macquarie Bank. And the last member, Paul Edwards, was previously one of the top credit officers at Bendigo and Adelaide Bank, and also has equally impressive track record. These members have managed many billions of dollars in credit assets through differing market cycles over their many decades in their careers, and have experience in both good times and the bad times, and that quality and that experience is really critical in managing the fund. Investors have peace of mind knowing that these staff members also invest alongside on the exact same terms as our investors in these funds, and also that the firm is overwhelmingly staff owned, which means we go the extra mile in everything that we do. The Manning Monthly Income Fund focuses on three key asset types in the Australian market. Consumer loans, that is loans to individuals for sound loan purposes. Mortgages, both residential and commercial, that are written at conservative LVRs and typically for a 1 to 2 year term. And business lending, so that's lending to better quality businesses that are secured by a real asset, such as a car, ute, van, etc. So the third area we'll talk about is just our investment process. So the investment process starts off with a macroeconomic outlook. And what we're doing there is assessing where we are in the economic cycle, what is the conditions that the Australian economy and within a global context is facing into. And we look at a range of leading, lagging, coincident indicators to form that view. That then informs the stage 2, which is portfolio construction. That is looking at what types of weightings do we want in mortgages, consumer loans, business loans in the portfolio. When we look at, say, mortgages, it's not just do we want mortgages and what percentages, do we want residential or commercial? In, say, residential, what type of residential loans, what sort of geographies are we looking to focus on, and where are the different pockets of risk that we really need to be avoiding? Stage 3 is then looking at different counterparties. So we might say we want a certain allocation to mortgages. It's about looking at the many hundreds of lenders in the Australian environment and assessing which is the best counterparty to buy those pools of loans from. And we do that by following our proprietary 10-step, 100+ point due diligence process, where we form a very deep understanding of who these lenders are and how attractive those assets are on a risk-adjusted basis. The fourth step is structuring so-called safe investments. So there we're looking at buying loans off these vetted counterparties, and we can either buy those as a whole portfolio of loans, we might just buy a singular slice of their loans across the book, or in certain circumstances we'll actually pick out the most attractive assets in their broader book. And that's all wrapped up with a stage 5, which is the ongoing monitoring and analysis that we do on all counterparties that really informs the stage 1, the macroeconomic outlook. This investment process over the past 7 years we have found has delivered asset diversification, high returns, consistent income, low volatility and capital stability. The following slide just shows you just how active we are in terms of managing the portfolio. We're focusing on what we call shorter dated assets, where we're typically investing for 12 to 24 months. And that means we can be very active in changing the composition of the portfolio to come in and out of sectors as the macroeconomic outlook changes, but also the internal market dynamics of Australian credit markets change to really help optimise returns, but most importantly, protect investor capital. Manning manages money for a range of high net worth, family office, ASX listed companies and charitable organisations, and will welcome your interest in the fund. So please reach out to one of our team if you'd like to understand it further.